Good morning, everyone. Welcome back to another Monday live stream here with the Everyday Growth Advisors. Hope you are having a good morning. So far, so good. We are kind of interlacing this market with the new macro backdrop, which kind of popped off last week. As you all know, there was a bunch of news that came in, and then a bunch of Fed speakers that came in that kind of mentioned a couple of different things. And let's review this again because I think we all need a refresher that for the May Fed cuts or interest rates, there is a 95% chance that the interest rates will be unchanged. And now, basically, for the June meeting, we are at a 50-50 coin flip between having a rate cut and not having a rate cut, which this week will decide. You have a new earnings season starting on Friday. You have CPI on Wednesday. You have jobless claims on Thursday. There's a lot of data that will come out this week to give us more information on where this market's going to head in this next coming quarter. New quarter starts from this week, and so we will be seeing after that. You can see the market even more diluted in terms of where it's positioning itself for the July meeting, and then the September meeting is completely delulu, right? In fact, look, in the September meeting, there's even a further rate cut on the line. There's potential 2 rate cuts on the line. And then there is a 9% chance that the market's pricing in that interest rates stay the same till September. So as we get more data here, we will continue to share during the live streams and keep you guys updated. So let's jump into the technicals. And there's quite a bit to cover today, so I'm going to go through it pretty fast. As usual, if you have any charts that you want me to break down, go ahead, put it in the comment. And good morning to all of you guys. What's up, Jerome? So first things first, Bitcoin broken out of its pendant structure that it's been forming for a while. This is potentially going to send the market in, risk assets in risk on mode. Could potentially send Bitcoin higher and then bring back some risk appetite across the market. We are seeing the S&P 500 here still kind of reclaiming some of the previous levels that were broken from last week. The inability for S&P 500 to claim back 5220 and use this as support, it might cause a little bit of short-term sideways movement. And you can see on the NASDAQ, we still haven't broken down key levels here, right? The key level still remains upside pivot at 18,415 roughly, and then downside pivot still 17,800 or so. That's downside pivot. The Nasdaq needs to come down considerably in order to go into a corrective territory, but we still haven't been able to see that. With the S&P 500, we also haven't seen a very massive pullback. We've just seen a very nominal pullback. In line with what we expect for a normal pullback on a bull kind of a wave. So this pullback here, snapping up some liquidity after the Fed speak, and then again after that Powell coming on and saying other stuff, kind of reissued confidence in the market. But as of right now, the S&P 500 is still not in correction territory. I mean, if you realistically look at this, just from where we're at all-time highs to where we are right now, it's literally a 1% move so far. So not really much going on in terms of price action just yet. No major moves, no major corrections. Of course, do remember that this level here, the 51.13 level, becomes a very strong level of support as it is a dual zone. And that will be kind of last level of defense here, up all the way up to 51.40. So we'll be watching that key level heading into the CPI this week as well. Okay, IWM still kind of hovering in this area, and my thesis about this still hasn't changed as more gets priced in here. I think IWM might see a potential pullback in the short term, and as long as it doesn't break this 198 to 200 as I've been mentioning, we should be okay. We want it to hold this level though, because if it breaks below this level, then it's potentially going to see further squeeze back down into this area here, which we don't really want, right? So we want to see this hold above, and for the expectations of interest rates to stay at like a cutting zone, and that should bring renewed faith to this sector of the market. Now, in terms of 10-year yield, we saw last week, that was a main needle mover on why the market corrected downward a little bit. You could see that we broke out of this area which we were consolidating in, which was the 4.345%. And upon breaking that, we have been kind of moving higher here. And the bond market's kind of pricing in the likelihood that the interest rate cuts may be delayed. And you can see that as reflected in the percentages which I showed you earlier, right? On top of that, you had the VIX that kind of spiked up last week, which we were already prepared for, right? As you know, we have been in VIX calls for a while, but these are not profitable yet. So we will be continuing to hold it until another week or so. My last week's P&L was about 4,000, which is not too bad. And so far on this year, we are currently at 14,729. I took some bad trades last week, but nothing that my risk management couldn't solve. The average loss in the trades were between 20 to 30%, as you can see. Every single trade was tracked and recorded down here. Of course, I have some open trades that have losses that are not realized yet, which will be realized in due time, right? But I don't need to close them out just yet because they don't expire just yet, right? So we'll be holding those for a little while longer. Now, dollar index, it briefly showed signs of breaking out, didn't break out, then came back down, and then got bought up a little bit. So now dollar index consolidating sideways. Now, one of the reasons why the dollar index came down last week was because commodities were going up, right? Gold was getting squeezed higher, oil and energy was getting squeezed higher. So that puts natural pressure on commodities because remember, when things that are denominated in the US dollar, if they go up, then the US dollar comes down, right? So if the commodity industry kind of, you're talking about your oil and gas or whatever, goes up, then your dollar is going to have to come down. So that kind of a correlated pattern exists with the dollar index. But remember that the dollar index is also a measurement of US dollar across a basket of currencies. So there's a lot of interacting things here, but this is a good general understanding of how the interplay between the currencies work out with different asset classes. One sector that I'm watching, top watch, is utilities. And I think I've been through this before. The top sector within this ETF is NEE. This is the highest allocation. I will probably be trying to play a bullish position on this if it can break above $65 and take this play to the upside at around $68 to $70 for a swing trade. But that is only if the market conditions continue to deteriorate. So people usually flock to utilities when market conditions are bad, and right now we don't have that just yet. China also looking like it has been consolidating at this level here, which might be renewed for a upside play. Only if it breaks above 27, 28 though. That's where I'm comfortable taking some of this upside. Tesla today up around 2% pre-market. Elon Musk is going to be announcing its robo-taxi thingy for I think, what is it? I don't know what time he's going to announce it, but I know there's a robo-taxi announcement today, and that's what the market's harping on. As a result, Uber and Lyft are down, and Tesla is up pre-market. And then you have McDonald's that got heavily sold off last week, which I might be looking for a potential bounce play on this week, or continued downside play if we continue to reject the 268, 267 here. This is just some of the plays that we are going to be taking. Once again, all this is posted on Discord. Even if you're a free member, you get access to the snipe list. These are our picks for this week. We have Morgan Stanley, which is continued from last week. PayPal continued from last week. Amazon, which is potentially a price discovery play, and then McDonald's, which has two setups possible here, one a bearish setup and a bullish setup. Everything is in the Discord. If you don't have the link to sign up, you can reach out to me and I will give it to you to enter the server to be a part of the free roll. Now, Amazon, very simple setup here. This pivot is going to be 189 break, 189 reject. That's your 2 points here. PayPal and MS haven't changed from last week, so we'll be using almost the same points. Microsoft still flagging in a sideways bull channel, and EE I just mentioned. AMD and NVDA both looking pretty weak. If they continue to break down further, I will be looking for NVIDIA short only below 850, and I'll be looking for a AMD short only below, what is this level here, 161. So apart from that, not really else that I will be looking into for these two specific plays. XOM, I think this one's a bit too far gone. I definitely don't want to go long here, right? And then you have Square, which is going to be a pretty much nice potential bounce play here. This one saw a little bit of bullish activity. By the way, Tesla saw insane bearish activity last week, but I'm not inclined to follow that activity because news can change that, right? And I just wanted to mention that there was flow on this. But Square also has been seeing some nice bullish activity for some 85 and 88 calls coming in the whole of last week. Apart from that, we have, I think, two of the nicer plays are Netflix for a potential further upside. There's a nice little area here which we could capitalize on if it breaks further. Of course, this is a daily chart you're looking at, so this is a kind of macro level. But for this week, if it breaks this level here at the 640, 650, there's going to be a pretty big move to the upside. So we'll be watching that closely for a potential rally up into the 680 or 700 after that. Meta also, this one was moving inverse to the market last week. The market was coming down, Meta was moving up. So this week, if the market starts to move up, I expect Meta to come down, kind of undoing the correlation. Or if it goes up further, then it has to break above this, 530, which I think right now Meta might be, it's in price discovery. So it needs to break firmly above this level here in order for us to keep going higher. And I would be okay with trading this to the upside all the way up into the 560s. If it breaks and find some momentum here. So these plays are two that I'm looking at. Disney I don't quite like right now. I'm going to even take this off my list. Google is the other one which I am potentially looking at, which has been in a kind of a weird, I want to say megaphone pattern, so-called. I like to call it the Big Bang pattern, right? Looks like the kind of the universe expanding here from here, right? So Google also, I think, price discovery, right? So all these need to break with some strong momentum in order for us to play it, and I don't see that just yet, but I would be happy to take some Google if it can consolidate a little bit more downward. I might be happy to take some of that. This play we missed last week, FCX. This was a great play. Material sector, it's been popping off. I didn't catch this even after mentioning it on the live stream multiple times, unfortunately. But that's all I have today. Macro environment is changing, guys. Be aware of that. And I would say that this is not a bad time to hedge your portfolio. Okay, it's not a bad time. In fact, ahead of CPI this week, ahead of jobless claims on Thursday, and ahead of a new earnings season on Friday, it wouldn't hurt to buy some hedges on the S&P 500, or that's if you're heavily in S&P 500, let's say your portfolio is. Or if your portfolio is heavy tech, then you can go buy some QQQ puts, right? But don't go crazy with the sizing. This is where people mess it up, right? So make sure that you're allocating the right amount of risk. Your hedge shouldn't be, a massive position. It should pay out a decent amount of money if it comes true, but it should also protect your portfolio, and you should be in a net positive scenario if the hedge doesn't pay out. That means if your hedge goes to zero, your equity should, or whatever that you're trying to hedge, should gain more than when your hedge doesn't pay out. Does that make sense? So you need to make sure that your position sizing on the hedge is correct. For me, I don't exceed more than the value of my 10% of my value of portfolio to hedge, right? So my hedge would be anything between around $5,000 to around $7,000, and that's as deep as I'll keep it, right? So you can see, even with my VIX position, my current hedge is sitting at around $6,700, right? That's the risk that I took on for this position. So I'm not really going overboard with my hedge just yet. And the reality of it is, if the market moves higher and then my VIX position dies, the gain on my equity portfolio will be much higher than that $6,700. So therefore, the value add of the hedge is a net positive. You see what I mean? So that's kind of how you want to employ these tactics. And if I take a hedge this week, I'll post it in Discord, which I think I'm going to. So that's just as far as I'll go with this. I think there's not much else to talk about. We have seen 2 consecutive lower highs and then a potential third one coming up here. And we've seen 2 consecutive lower lows, which are now potentially forming into a downtrend channel, right? But we don't have validation yet. Why? Because there's no break of structure and liquidity here. This is the issue. We have the lower highs here, right? And the lower lows, but we haven't broken the key pivot. The key pivot is 51.13 all the way to 51.40. This wall has to be broken to explicitly force buy limit orders to come in and push this market up. So in other words, we need market makers to engineer liquidity in this area for the market to come back up so that we can get an opportunity to eventually sell down into this. So that's what I'm looking for here for this bearish correction to start, which hasn't happened yet. We've been talking about it for a couple of times, but it just hasn't happened yet, okay? And so until that happens, we can't really take a full bearish position just yet. It's gonna have to be where you're gonna be really careful with the way that you are positioning yourself. You will be looking at bullish pops this week. In other words, you'll be looking at potential snap rallies throughout the day, reversals throughout the day, right? But at the same time, you should also be aware that when those rallies do happen, they are a potential entry for short. So in other words, volatility is going to return back to the market. And when volatility returns back to the market, that's the absolute best time to be trading. Your spreads get tighter, liquidity gets bigger. It's just a better environment for traders in general. So the good times are about to come. You have to be patient. The sideways action is obviously very droning and it doesn't make you feel good, but the times are coming for where we are going to take advantage of this, and all the capital that we've been saving or not spending is going to come into play. This is where a lot of people blow up their portfolios. This is where the market moves sideways. They don't know what to do. They don't know how to sit on their hands. They don't know how to not trade. And then what happens is they try to speculate till the time where they blow up their portfolio, and then they're like, oh man, I shouldn't have done that, right? So the time is coming soon. Just be patient. And I think it's a good time to hedge right now. You can obviously take a small position and then ride it out into at least 60 to 90 days. That would be the typical hedge. And if the hedge works in your favor, then you get a payout. If it doesn't, then it's going to be a net add to your portfolio anyway, because your equity will go up further. So not a bad scenario here. And yeah, that's all I have for you guys today. On your way out, if you can smash the like button, I would appreciate it. And if you have questions, I'll be here for another minute to answer them. So yeah. So we have, what are the catalysts this week? There are some catalysts. So also another thing that I forgot to mention was, as you guys recall, that since the month of, I want to say, what was it, February, right? Since the month of February heading into March, the most of March here, we saw institutions exit positions. We saw a lot of exits being drawn in this area, just so you know, okay? It's been already 8 weeks consecutively. So we're in the first week of April right now. Okay, this was April beginning, let's say here, right? So April is here. It's been 8 weeks. So the whole of March and then the whole of February, okay, with the exception of 1 week, all right, roughly. So this whole period here, the market has, market makers and institutions have actually been selling on the way up. Okay, they've been selling. So how do I know this? Because we've been reading the prime book reports, and I've been telling you every time that we have been moving further up, I've been telling you guys that, hey, you know, a lot of people have been selling at this point, right? So you can see even here on the prime book positioning report, right? Just read this, right? You can see, see, where is it? I just read it earlier. Here. U.S. single stocks were net sold for a second straight week, 3 of the past 4 weeks, driven by short sales outpacing long buys, 2.5 to 1. U.S. single stock short flow has increased for 8 consecutive weeks. You can see that, right? This is by your Goldman Sachs Prime Broker report, right? 7 out of 11 U.S. sectors were net sold on the week, that's last week, led by notional terms in com services, consumer discretionary, healthcare, while info, tech, utilities, staples, and financials were net bought. Okay, so you can see the reason why I want to go long on utilities too, right? And consumer discretionary was among the worst performing and the most net sold sector, driven by long and short sales as hedge funds reduced long positions every day this week and shorted retail ETFs. Specialty retail was by far the most sold subsector, followed by household durables and textiles, apparel and luxury goods, partially offset by net buying in autos and broadline retail. But why is the market up? Or why is the market rebounded and held? Because infotech was the largest net buying in 5 weeks, driven by long bias, outpacing short sales 3.5 to 1. You can see tech, hardware, and semi equipment were the most notionally net bought subtractors, while electronic equipment, instruments, and components were the most net sold. So these kinds of detailed reports really do help you in understanding where the smart money is hitting and where they are coming from. It's just one of those things that, you know, we take the time to do here. Okay, Nike. Let's see. Thoughts on Nike for leaps? Okay. Yeah, I mean, it's not a bad spot here. Definitely not a bad spot. I would want to see if it holds this level though first before I take leaps, to be honest. I wouldn't just go ahead and buy them right here. I would wait till 82, 86 is tested. And if it really does come down, you know, then you can add some positions. But I would wait for at least 82, 64 to be tested, because it looks like it's going to break. That's a pretty damn bearish candle on the weekly. It looks like there will be follow-through action on Nike here. In fact, this is a good setup for a potential day trade, right? Short this thing down from 88.80 all the way down to around $82. The $80 puts will probably be able to cover that. But I would see if it bounces in this region here before you go for leaps. Just like how you never buy a stock that's running, you don't, you know, buy a stock that is selling off neither, because it can keep selling, right? So always follow the trend, my friend. That's my advice. All right, well, I don't see any more questions. If y'all don't have any more questions, then I'm gonna hop on the trading room and see what's going on there. All right, I will see you all back on Wednesday. Have a good trading day. Take care and peace out, guys.